The used equipment market could be shifting away from the buyer's favor. Another truck recall, this time for Peterbilt's, has been issued. Plus, there are over 2,000 trucks placed out of service during this past August Brake Safety Week. We'll get into these stories, plus dig into the latest recruiting data and check in with Jason Miller for his thoughts and economic outlook. For Randall Reilly, I'm Joshua Miller, and this is the 30-Day Reset. Hey everybody, welcome back to our show. Before we dive in, if you haven't already, please take a moment to like, share, and subscribe. And if you could, go ahead and click that bell down there while you're at it too. Don't forget, you can get a copy of all the data and stories we'll cover today down below in our download for this edition of the 30-Day Reset. First up, it's Trucking by the Numbers, brought to you by Stratas, Strategize. As things currently stand, the lead and hire costs are a bit of a mixed bag, but the underlying fundamentals continue to indicate an environment leading to attractively inexpensive leads and hires. Search activity has dropped from the all-time high it reached in August, but levels are still elevated. Only 14% of months since the beginning of 2019 have had higher search volume than this past month's numbers. Overall average lead costs are on pace to reach the second lowest level since May of 2020, with only the August CPL being lower. When it comes to freight, the total load volume was down 24% year over year and 30% below the 5-year average. Load volume was down in all regions and all of our major segments. Dry van loads were down 25% compared to last year, while refrigerated and flatbed volumes dipped by 23% and 22% respectively. And all three segments were 30% or more below the 5-year averages. The total spot rate numbers were down 12% year over year and 5% lower than the 5-year average, and all three segments were also down year over year and when compared to the 5-year averages. If you'd like more detail on the individual segment load volume and rates when it comes to those year over year and 5-year average specifics, you can find those numbers in this month's 30-Day Reset download, which is again available down below. Now for this month's headlines. It's been a buyer's market in the world of used trucks, but that could be coming to an end. As freight levels stabilize or perhaps even grow and the number of trucks hauling freight slips, used truck capacity may shift away from the buyer's favor. The strength and number of Class 8 orders help drive used equipment prices up or down. The data released in October for September orders seems to point to a strong open for the 2024 order boards. If that momentum is maintained, that could have a big influence and flatten used truck inventories. PACCAR is recalling over 1,300 Peterbilt 579 and 567 trucks from the model years 2021 through 2024. The cause? According to documentation from the National Highway Traffic Safety Administration, U-bolts used to attach the air tank to the chassis may rub on the fuel tank and risk wearing a hole in the tank, which results in an increased risk of fire. Dealers are offering to inspect, trim U-bolts, and replace any fuel tanks if necessary, free of charge. Owners of the recalled models can contact Peterbilt's customer service at the number listed on the screen and use the recall number 23PBH for more information. And finally, over 2,000 or 12% of the total number of vehicles inspected during the recent Brake Safety Week were found to have defects serious enough to place them out of service. A total of 18,875 commercial motor vehicles were inspected in the U.S., Canada, and Mexico between August 20th through the 26th. Of those inspected, 295, about 12.5%, had steering axle brake violations, 1,127, or 47.5%, had standalone brake violations, and 1,394, or 58.7%, failed the 20% defective brakes criteria, stating that a vehicle is out of service if the number of defective brakes is equal to or greater than 20% of the service brakes on the vehicle or combination. Wow! Next year's Brake Safety Week is scheduled to take place August 25th through the 31st. And that's it for this month's headlines. It's time to check in with our friend Jason Miller for his thoughts and latest update on the economy.
So in this month's market update, what I want to talk about is where things are at right now in the current freight market cycle and answer the question of, are we starting to see any evidence yet of the market turning? And unfortunately for carriers, but good news for shippers, the answer to that is really no evidence yet of the market turning. As proof of that, what I have here is what I call the dry van spot market cycle indicator. What this is it's the difference between broker buy contract rates and dry van spot rates, including fuel surcharges from DAT, over the average of the two. And what we see is a very consistent pattern. Anytime that index gets below about 10%, we tend to be in a bull market territory in terms of pricing. We saw that in mid-2013. We saw that achieved in mid-2017, and then we entered that in June of 2020. Conversely, anytime that index really gets above 15%, we tend to be in a very bearish territory in terms of pricing. We saw that happen towards the second half of 2015, in the start of 2019, and then at the start of the second quarter in 2022. And that corresponds very well to our historical changes in the pricing dynamics. What I want to emphasize is data through October is putting that ratio at about 21.4%. That means that we are nowhere near seeing the market turn. So unfortunately, we're not going to see that this year, and it's again very likely going to take at minimum into the middle of next year before we start to see evidence of a change in market cycles. And one of the things that's really driving the sustained bear market is the fact that trucking activity and demand continues to be well below where it was during the sort of peak period in the end part of 2021 and the start of 2022. So shown here is the trucking ton mile index that I co-author with Yembo Imola at the University of Tennessee. Right now in August, we may have had a slight seasonally adjusted bump from where we were in July, but we're down 4% from where we were in early 2022 on a seasonally adjusted basis. When you combine the fact that demand is down and supply is up, you have a recipe for a sustained bear market. And another thing that is sustaining the current bear market is the fact capacity is not exiting as quickly as many folks expected. We recently saw the CEO of Knight-Swift making that exact statement during that company's quarterly earnings call, which brings up the question of why not more exit? To me, the answer is contract prices. Contract prices, on average, have been far more resilient than spot prices over this cycle. And where that's really picked up is this index of essentially general freight truckload prices, both local as well as long distance, compiled from the Bureau of Labor Statistics. Right now, on aggregate, including fuel surcharges, even though those prices have come down from their highest levels achieved in 2022, where they were 50% above pre-COVID levels, right now they're still about 20% above pre-COVID levels. And they've come down sort of smooth and steadily over time. So given 2021 was a record year for trucking profitability, 2022 will likely be the second highest year of profitability, given how strong the freight market was in the first half of the year. That's provided a lot of additional resources for carriers to weather this downturn. The other factor has to do with diversification. When we talk about dry van carriers, what we fail to appreciate is they obtain about 40% of their revenue on average from other sources other than over-the-road dry van movements. And that could be flatbed, that can be refrigerated, that can be having a chemical subdivision. And what we've seen is those prices for those other specialized services have been much more resilient during the current downturn than that dry van over-the-road sector. And that shows up by the fact that the primary services producer price index for general freight long-distance truckload carriers has declined much more than the full index, which is including all those specialized services. And that maps very well to what we observe for specialized long-distance carriers. Their prices have been much more resilient during this current freight recession. And so when we're talking about capacity not exiting as quickly, that also sets a scenario for a much slower shift towards a bull market as we're moving along this bear market. Once we come out of it, I would tell folks, don't anticipate the sudden swings like we saw in 2017 or especially 2020. It's likely to be much more gradual this time around.
Thank you, Jason. We hope all the information and data discussed on today's show has been useful and informative to you. Don't forget, if you'd like your own copy of everything we touched on, you can find that down below on the 30-day reset download. It hits everything we talked about, and it even goes into greater detail than we had time to do here today. There's also links for a Contact Us and Strategize down there as well. So if you'd like to talk to one of our associates about anything, or if you'd like to have the ability to dive into the data for yourself with Strategize, just go ahead and click on one of those bad boys and let us know. Until next time, thanks for watching.